A new quarter has us welcoming a new Fed chair. Now, Kevin Warsh did do his first press conference in the mid-June, but we are looking forward to what he's going to bring us over the next 10 to 12 years. And it looks like it's going to be a major shift in policy. And why do we care so much about one guy? Well, number one, he is a guy that really wants to transform the Fed. He is not looking at status quo. And he's also a known quantity. He has served in the government before. He's got a lot of experience in economics in the Federal Reserve. And he is somebody who's written prolifically about the role of the Fed. And so the things that we're watching for with him is number one, they really want to overhaul communications. And that is a big change. And the market loves to be led somewhere. The market has loved all of this forward guidance. The market loves it when Powell came out and he spells things out. And the monthly note that they release is about a page long. With Warsh, he took about down to a paragraph, meaning he said, I don't want to give forward guidance. I'm not going to do that anymore. I don't think we should do that. So that's going to be a major change on how the Fed communicates. What that might mean is that the market might start guessing a little bit more. And that may mean the market may be a little bit more volatile as we try to read the tea leaves without as much help as we used to have. So this is a big policy overhaul. The second thing, and the thing I'm very concerned about, is the balance sheet. Warsh really wants to change what the Fed is doing, and one of its very effective tools has been to expand its balance sheet, buying bonds, and during times of stress, they actually bought stocks and ETFs during COVID to support the markets. Warsh may actually turn that around. Number one, we might start running off the balance sheet faster, which means, again, that's draining liquidity from the system. As they have bonds mature, they may not buy them back and replace it, shrinking the Fed's balance sheet, which is just pulling some liquidity out of the market. Number two, he's saying, hey, we should really only own treasuries. That may mean mortgage-backed securities, of which the Fed has been playing in for the last about decade, may all of a sudden become under a little bit of pressure because you're going to lose one of your biggest buyers of that. So the Fed balance sheet can have a huge shift. And then the last thing is interest rates. Now, Warsh was a Trump pick, and there are assumptions that he had to have promised to cut rates. I don't know what was actually said behind closed doors, but the prevailing logic is there was no way he got the Trump thumbs up by saying that he wasn't going to cut rates. Now, he is now between a rock and a hard place. Inflation is high due to the high oil and gas prices from the war in Iran, and so it's really difficult to actually cut rates. But is he going to support hiking rates, which is something that the dot plot, as broken as it may be, was signaling that, hey, we actually might get a Fed hike this year. It has massive impacts across the entire investable universe. And so for us, we're really interested in what he brings. On one hand, we feel like he's going to push to lower rates. On the other, if he's running off the balance sheet, that could kind of cancel out any of the dovish effects that lowering rates may bring to the markets. So we're expecting a little bit more volatility. And candidly, we do expect hikes. We will be watching inflation trends very, very carefully. However, inflation has a really bad habit of being what we call sticky, meaning it goes up significantly faster than it likes to come down. So all of it's interconnected. We're just saying, hey, with someone new at the tiller, we got to be a little bit more careful on our assumptions, and we have to be a little bit more wary about a hawkish Fed, because we certainly don't want the double top in inflation we saw in the 1970s and 80s.